when recording the balance sheet, we're looking at what we own and what we owe as at the 30th of June for the company. You will need to know your layout as well for a balance sheet. And so we'll start off first of all with our non-current assets. Non-current assets is anything that the company is going to hold for a period greater than 12 months. The first one we looked at, you'll see in the question, is where we purchased the premises. The premises value, it does not depreciate, and in this case it is just held at the cost of 600,000, and we just note it as that. The next non-current asset that we have is machinery. Machinery was bought at a cost of 240,000, but it depreciated. Now, bearing in mind we purchased the machinery in January and we're showing the balance sheet at the 30th of June, so that's 6 months depreciation. We had calculated already depreciation at 2,000 per month, and if you go back to your working on depreciation in our previous online screencast, you will see our depreciation per month is 2,000, and we're reducing the cost of our machinery by 6 months depreciation. So that would have been the cost at 240,000 minus 12,000 of depreciation. We have then added together the premises plus the net book value of the machinery, or the value of the machinery as at the 30th of June, and that will give us 828k. The next item we list within our balance sheet are our current assets, and current assets, remember, are anything that the company is owed within 12 months. As at the 30th of June. The first one we list is stock, and stock is 70,000, and you'll see that to the notes in the question itself. So you'll see where stock is given at 70,000, and that's the stock value at the 30th of June. The next we list is our bank account, and our bank account is 86,500. We have got that from our cash budget that we calculated in part A, and if we look here at our cash budget, you will see at the 30th of June you had a bank balance, the money in the bank, of 86,500. Receivables. Receivables are any sales that we still are owed, and we have to check how much we are owed at the 30th of June. And if we have a look at our sales, you see that our sales are paid 2 months after. This is credit sales, so 75% is credit sales. So let's have a look. May, we had sales of 180,000. We multiply 180,000 by 75%, and that gives us 135,000. We are not paid that by our customers at the end of June, and so it's still owed to us. June, we had sales of 190,000. Multiply that by 75%, which is the credit sales, and again that was not paid as at the 30th of June, and so we total our two sales still owed to give us 277,500, and we include that into our current assets on our balance sheet. Adding together the stock, bank and receivables, we have 434 of current assets. Our total assets figure then is simply adding our non-current assets with our current assets. The next item on our balance sheet is looking at equity, and within equity we're going to take the capital, and the capital is what has been introduced by the three investors. We have a total of 280,000, but if we have a look at the question to see where that 280 came from. Tom invested 100,000, for which he received 70,000 ordinary shares. So we have 70,000 in relation to capital for Tom. Dick received 80,000 in relation to capital, and Harry received 130,000 in relation to capital. And we simply add those three figures together, and that gives us the capital for our balance sheet of 280,000. Our profit figure is simply taken from our P&L or our income statement. And so you will see we calculated 333,500 for our income statement. We carried that in to our balance sheet under equity. Adding together our capital and our profit, we have 613,500. The next item within our balance sheet are looking at our liabilities. We can separate our liabilities into non-current liabilities and current liabilities. However, in this case I've just shown them all together. The first one we're going to look at is our debentures, and debentures is the investors lending money back into the company, and so the company of course owes it out to them. The debentures is 110,000 and is calculated as follows. Tom had 30,000 of a debenture, Dick had 40,000, Harry had 40,000. We simply add those three together, and that will show us debentures of 110,000. The premises. We're looking at what is still owed on the premises. Again, going back to the question itself, we had purchased a new premises, and if we look there on part J, we had purchased it for 600,000. It is paid by taking out a bank loan, which is paid in monthly instalments of 50,000. We have 6 months of instalments, which is 300,000 that has been paid, which means that we have 300,000 still owed. So we take the cost of the premises minus what we have paid, and you will see within our balance sheet 300,000 is still owing. Machinery, likewise, we're going to take the cost of the machinery back to the question minus what we have paid, so we need to show what we still owe in that case. And back to the question again, if you see there in part H, we had purchased the machine at 240,000 and we are paying monthly instalments of 20,000. So that means over 6 months we have paid 120,000. Okay, and just be careful there, we have paid 100,000, apologies, because it starts the month following the purchase. So we purchased the machine in January, the cost 240,000, and it's paid at 20,000 per month. It starts repaying the month following the purchase, and so that means we're going to pay in February, March, April, May and June, which is 5 months at 20,000, 100,000 taken away from 240. And that means that we still owe 140,000 for the machine. Purchases still owed, again, is June purchases of 50,000. We still haven't paid those at the end of June. Debenture interest owed, again, to have a look at how we calculate that. Tom is owed a total of 3,000 of debenture interest per year. That's got by taking his debenture of 30,000 and multiplying it by the interest rate of 10%. Dick is owed 4,000 per year, again taking his debenture of 40,000 and multiplied by 10%. Harry is owed 4,000, taking his debenture of 40,000, multiplying by 10%. We've added up the three of those to give 11,000, and again that's per year, but we only want the interest for 6 months up until the 30th of June, and so we're dividing that by 2. Again showing that within our liabilities. Other expenses owed, again going back to the question, we are told that they are paid 1 month following. So we still owe for June other expenses, which is 5,000. Overheads owed are 38,000, and how we got that is our June overheads are 40,000, but we need to amend for 1 month's depreciation, and so we take 40,000 for June minus 2,000 depreciation, and again that 38,000 is not paid until July, so we still owe it at the end of June. Adding together all our liabilities, we have 648,500. We add those, of course, to our equity, and you will see that we have total equity and liabilities of 1.262 million, which balances with our total assets.